And we're live. Welcome everyone to the Savvy Real Estate Investor Show. We have a special guest today, Jeffrey Donis. Jeffrey Donis is a real estate investor and syndicator. Jeffrey and his two brothers started investing in single family, and now they built up a portfolio of cash flow and rentals and a six-figure business. Their goal is to empower others to achieve their financial goals through apartment investing. The Donis brothers' passion for helping people began at an early age and has bound them as brothers and business partners. The Donis brothers are also the hosts of the Real Estate Monopoly podcast, so check them out. A show where they interview investors who are dominating the real estate industry. Jeffrey is responsible for raising capital and investor relations at the Donis Investment Group. Jeffrey, welcome to the show.
Thanks, Ed. Thanks for having me, man. I know that you mentioned, we spoke over the phone a few times, but never got to meet face to face. So this is as close as we've come.
Love it, man. Wow. Nowadays with all the virtual stuff,
Right.
this tends to happen a lot, right?
For sure, man.
Um, yeah. Well, dude, catch me up to speed on what you got going on. I like to get to the meat and potatoes. I know
Yeah, yeah,
you were in the single family space. Were you in the single family space and then you transition over to multifamily, or how did that go?
exactly. So we were doing, and by we, I work with a twin brother and an older brother. So we got into real estate together. We're still working together, thankfully. So we got into it through wholesaling. And I don't have to break it down, but we were doing a lot of wholesaling, a lot of creative financing, all in the single family space, heavily doing a lot of marketing and very transactional. I'm not sure if you've had, I know I'm assuming that you've had experience in the single family space, but in regards to that being so transactional, that wasn't something that we really loved to do. Putting out all these fires and putting in so much work didn't feel like it was we were getting the results we wanted. So that's why we ended up just learning more about commercial real estate and eventually fell into syndication, and that's kind of what sparked that journey as well.
Yeah, I know. I still have my wholesaling business, and I can relate about the fires.
Yeah,
What do you feel regarding the fires? Because obviously, I think in every business there is problems, right?
for
That's
sure.
inevitable. But as it relates to fires, would you say that there's less fires to deal with in like big multifamily deals as opposed to
Yeah,
wholesaling single family homes?
yeah, and Grant Cardone, which I love his content and his books. People don't like him, but I think he's got a lot of good things, a lot of bad things, like anyone, right? But something that he loves to say is new problems are good problems. Like if you're not having new problems in your business, that means you're not growing. So I completely think that having fires is a good thing because that means you're coming up with different solutions, and then eventually you're going to run into another problem. But the difference for me was the end result and the outcome and the like the I guess like the result or whatever like that comes after the equation, right? After you put out a fire, the reward that I was getting from doing that in single family wasn't necessarily worth it to me. Like we were like almost closing, and we'd have to go and find out who was the seller on title, and you'd have to call 10 people just to get like 5 grand when we were wholesaling. And for us, that just wasn't worth it. In our markets, that may not sound like a big spread to you all. Maybe you're in California and you're doing really, really, really big spreads, but for us, 5K was probably a large amount of the deals we were doing. We were just making a few grand here and there, and it wasn't worth it. And for us nowadays, and the new problems we're having, it's just growing pains, like setting expectations with our investors, for example. 2 years ago, I would have loved to have that problem because I'd never even raised money, right? So now that I'm messing up somehow because I'm doing something I've never done before, well, that's something that's awesome because I get to learn from it, and the next time that comes around, it won't happen again. And that's the great thing about what we're doing now. I think it's kind of more in tune with as we come up with these problems and these fires and you put them out, you're learning from it, and therefore you're improving your business and you're growing your business. Versus for me and my fires, what I was dealing with in single family, it was more so just to get like a quick paycheck and then having to reinvest that into my marketing again, and that just wasn't enjoyable for me.
Yeah, yeah, I totally understand that. Dude, do you how old are you?
How old am I?
Yeah.
Take a guess.
I think I must have asked you when we were first talking, so my answer probably is cheating, but is it 20, somewhere between 21 and 23?
Okay, good. I'm 20. Yeah,
20.
yeah, close,
Dude,
close,
that's
close.
awesome, man. So, obviously you're very well spoken, you come across a serious guy, very
Thank you.
accomplished. Do you have anybody that you talk to that has doubts because you're pretty young doing big multifamily deals?
Thank you for the kind words, first and foremost. But In regards to that, I would say less than people think. Like I don't necessarily across a lot of people that will question me. Or the one thing I do, and I can't really hide it, is I am young. I look young, so people will look at my face, do Zoom, and be like, they'll always ask me that question, "How old are you?" But more times than not, they don't even ask. So like
Yeah.
it's something that I think obviously when it does happen, I always do this, and I've done this from the beginning when I wasn't as informed in the business because I hadn't had enough time to actually learn what I was talking about. Was just to leverage my partners and my team, and that's how I still do to this day. I start the conversation off with who I'm working with because you can't necessarily. I'm a very transparent and honest person by nature, so I'm not going to lie about my experience. But I don't have to lie when I say my partner who I'm working with he has over 25 years of experience, over a billion assets under management. And by saying these things, before they even come up with how old are you, they'll know that I'm working with a reputable and a great sponsorship team. And at the end of the day, that's really what they care about.
Yeah. Yeah. Absolutely. I agree with that. The How are you picking who you're investing with and partnering up with?
Yeah, so that's a great question. I personally, on like the sponsorship side of things, I've been blessed to meet different mastermind or groups and leaders of different mastermind groups, and I've been able to just join those groups. And the way that I find them is just by taking in their content initially via the internet, and also just talking to other people that have been in different mastermind groups. So I join different groups, and then you just kind of start networking. So I was on Bigger Pockets, and that's how I found my first partner in multifamily. His name is Mark Kenny, and he has a great reputation, a great track record. I joined his group, and I love the value and the culture that they have in that group, and that's what attracted me to it. But after that, it's about kind of finding a way to bring value where you're going to be able to earn a spot on a team, right? Because you're not just going to walk in and be able to become a general partner. That's not typically how it works, at least for me. So I had to find a way to get creative and bring value. But that's how I found him, was initially just by consuming content and being a learner, right? Looking for more ways and different groups to join. So eventually I came up across his, and we ended up joining.
Yeah, I love that, man. Just and it totally makes sense, right? You get to connect with them on a deeper level and see what
Yeah,
they really are all about. What are as far as deals goes, what are some of your what is your criteria for picking up a deal?
for sure. So um, I like to invest somewhere nearby. So personally, wouldn't invest in Arizona right now because I'm in North Carolina. So just very far from me, and I want to be able to travel to the property because one, if I have my own investors' money there, I want to be able to say that I walked it, and it's a lot easier for me to go to Georgia or Atlanta, Georgia, than to go to California, which I would never invest in, but let's say Arizona or something like that. So that's the first thing. But the second thing I'm sure we all look at is population growth, job growth, right? Where are the people going? Where are the jobs going? Typically, people follow wherever jobs are moving into. Is it a landlord friendly state versus a tenant friendly state? And also, like I said, I partner with partners, so I like to invest where they've already invested, where they already have relationships with property management companies. Since we're using third party property management companies on our projects, all these things come into account. And at the end of the day, it's just places that are experiencing that growth because I think, especially during economic uncertain times, with the environment we're in now, with the Fed raising rates and all of this, I think it's more important than ever to invest in primary markets that are growing. And that's just my personal investment philosophy. That's why we're in like Atlanta, Georgia. We're in Jacksonville, Florida. We're looking in Charlotte, North Carolina, Raleigh, Durham, places that have been really, really good, strong markets even before all this was happening. But I think now it's more important than ever.
Yeah, yeah, for sure. What kind of asset classes are you investing in?
Yeah, right now it's just multifamily. I like to, obviously, I'm just I've done a few deals so far and looking to continue growing the portfolio, but I want to be focused and become a master at my craft first and foremost, and then eventually start to branch out perhaps in the future. But for now, we're just focused on multifamily.
Cool, love that. Is there a reason why you love multifamily more than any other assets?
So in regards to one thing is multifamily, someone will always need a place to live. That's just something that's common and everyone knows. But when you think of it in terms in comparison to self storage or industrial office space, retail, multifamily has proven throughout all these different downturns and different crises in the economy that it's going to perform better than all those just based on performances in the past. Also, for me, The reason I picked multifamily was because that's what, to be honest, that's what was like sexy at the time, and that's what attracted me to it. And that's really why I ended up choosing it. But as I learned more, I realized that it's been the most recession-proof asset class over the last few decades. So that's why we focus on multifamily.
Cool. Do you find, if knowing what you know now, I just asked somebody in the podcast yesterday, knowing
Yeah.
what you know now about multifamily and syndications, will have you, would have you done what you did in single family?
Would I have done what I did in single family?
Yeah. Or
In
would have you
regards
gone
to,
straight into full or multifamily?
it's a great question. So like obviously no. If I like didn't have to go through it, I wouldn't have, because I would have known everything. But if you're gonna ask, like, if I just knew about what I know about in commercial real estate and nothing else, and I would have never learned the lessons that I learned in single family, which I think is even hard to say. I would say no, because what I learned in the single family space, I don't know if you know this, but we started with wholesaling, like I already said. And you know this, that you cold call like crazy. And I used to cold call from 9 to 8 every day for like 6 months. And I kid you not, we would not turn off Mojo Dialer. And it would be all day, man, all day. So when you're doing that and you're overcoming that fear every single day, you're I became so numb to it. I actually became really good at it. And that's a skill that people, and I agree with, they'll say it's the number one skill you can have. And I think it's to go even deeper than that and more intrinsic is, if you can overcome fear every single day and do things that you don't want to do every single day, I mean, I think you're able to master that. And now you have that skill and you can apply that to every aspect of life, especially in business. So now when I have like an investor call that I'm a little scared to get on, or I have a problem that comes up, I don't see it the same way. And I think I learned that skill by kind of cutting my teeth in the single family space.
Cool. Yeah, that's very true. You mentioned something that I think is it's important, right? Because even though we invest in multifamily deals,
Yeah,
things go wrong sometimes, right?
for
Any
sure.
deal, we have a business plan, and as the business plan is getting implemented, there's things that may not go according to the plan.
Mhm.
What are some of the toughest things that you have had to call investors back and say, "Hey, listen, this is what's going on"?
Yeah, yeah. So thankfully, we haven't had anything in regards to like our projects, but in regards to, I'm not sure if you experienced this, but with K1s, going into like syndication and multifamily, as a single family investor, I wasn't raising money. Now we are, right? So that was something new. And as we got more experience with that, different problems with K1s started occurring, and I didn't set the proper expectation to my investors that there's a chance that K1s will be late and you're going to have to file an extension. Now, a lot of these accredited or non-accredited investors, since we do 506B deals, typically, they're the kind of people that are going to file their taxes way ahead of time, and they like to be punctual. That's just how they've been their entire lives. So, without even telling them ahead of time, that's going to cause even more panic than even if you were. But for me, what I learned was you want to set the proper expectation, and it all comes back down to one thing, and that's communication. Being a really, really good communicator, especially in my role with my company, which is investor relations and capital raising. The main thing that I've learned is it doesn't matter what it is, whether it's good news, especially if it's bad news, as long as you're being communicative, transparent, honest, and keeping that solid integrity throughout the entire process, that's the best thing you can do, regardless of whether or not the other person on the other end is going to want to hear it. They'd rather hear it ahead of time, and you set that proper expectation where they're not necessarily finding out at the last minute. That will just mitigate the amount of like challenges that you'll face, and it'll decrease the tension throughout that entire process. So that was the one thing that I can say that I've learned is communication is key, and it's better to be like ahead of the in front of the bull than trying to fix things as they happen.
Yeah, yeah, for sure. We had the same thing with K1s this year. They were
Yeah.
delayed. I think it was pretty common across the board, and definitely over communicating
Yeah,
to the investors is never bad, right?
for
Um,
sure.
where are most of your investors coming from? Is there a specific niche that you're like digging into, or is it very across the board, different sectors?
Yeah, so we're primarily, our investors have been in the financial industry, I would say, whether they're working at a bank in an executive role, or they are working as like a financial analyst at a company. We've also had some fix and flippers invest with us. Our primary target audience when it comes to marketing, because we have a podcast as well and we have content that we're putting out, is working professionals that are looking to pass on generational wealth so that their kids and themselves can live a life by design. That's one of my whys as well, is to help other people do that. And I want to do that for myself. I want to have time freedom, location freedom, financial freedom. And I think I need all three of these things to live a life that's actually fulfilling. And I want to help other people do that. So through the content that we're putting out there, we're kind of showing people that there is another way, and you can't have all those things if you're able to achieve financial freedom. And we can help you do that through real estate. So that's really like the target audience, and I guess what their needs are when it comes to our avatar.
What's one of the biggest challenges you face when you bring this new investment opportunity to someone that has always invested in the stock market?
Yeah, I would say a lot of people think real estate's risky. I mean, and typically they're thinking in the sense of single family. They're thinking in the sense of them being a landlord. Or they're thinking of, and people might think of like REITs and things, which I learned today that REITs do better than most of like the S&P 500 and all those stocks. But anyways, in regards to the, the way that you kind of have to shift people's mindset, I think it starts with the educational process. That's like the biggest challenge, because most people, they've never heard of multifamily passive investment, and we do 506B deals, so we're definitely not on social media talking about it and spreading the word, like like we're not publicizing this. So these are private offerings, and it's such a small like amount of people that actually know about it, that I think that's where the lag is when it comes to them actually understanding the investment. So that's the first challenge, I would say. And was that your question? What the challenge is?
Yeah, the challenges of like they see this new opportunity. You kind of already touched on it, right? The many think that is riskier than whatever they're doing, right? Putting money in the
Right, right, right.
401k.
Yeah,
Uh,
yeah. And yeah, when it comes to like the stock market, the way that I like to approach it is, well, one, that's not a tangible asset. Like you're investing in paper assets when you're investing in the stock market, and it's subject to so much volatility versus, and it's very liquid versus the real estate, the tangible asset. It's a hard asset, and it's not as volatile for many reasons, because it's not liquid. It's illiquid, meaning that you can't sell it quickly for various reasons, and especially with commercial real estate, you have to go through finding a buyer, doing due diligence, transferring title, all that. You can't do that in a day typically. I've never heard of anyone doing it in a day, right? So that's why it tastes illiquid, and that's a good thing in my opinion, because you don't want your retirement accounts to be able to fluctuate so fast by something going on that's out of your control. And at the end of the day, our projects that you're working at your firm and that we're working at our firm, we are operating these deals, and we have operating a team that's managing these assets, that's in control and has some type of direct control over how well that property performs. Versus with the stock market, you have no control. And as a passive investor, you may not think you have control, but at least someone on the team that you're investing in does. The stock market, you may not even ever be able to meet or have a conversation with these stock owners. Um, Robert Kiyosaki talks about this a lot. He likes to, the only way he'll own stock in a company is if it's his own company that he took public. He'll never invest in someone else's company, because for him, that's just unnecessary risk. And at the end of the day, with the stock market and all, I mean, with inflation being so high that it is right now, let's say on average you're making like 6%, you're not even beating inflation. And in real estate, let's say you're doing 6%, that may not be beating inflation, but if you're able to take the tax advantages and those depreciation benefits, that in itself is also an addition. So people aren't always as educated as I think they can be when it comes to the benefits, because if they understood it's not only the cash and cash and the IRR, but also the depreciation benefits that you'll get out of it, then they'll look at it a lot differently and see it for what it's worth.
yep, absolutely. You touched on something. You said 506B. Can you explain to the audience what that means?
Yeah, so a 506B offering is for us, it's the type of offering that we offer. There's a 506B and a 506C. 506B means you're allowed to bring on 35 non-accredited investors, but they have to be considered sophisticated. And that's like a gray area. The SEC defines that as, kind of leaves it up to you to define, but you have to have a substantive relationship with everyone that invests in that deal. And you're allowed to bring on unlimited amount of accredited investors. You're not allowed to go and market this. That's the only difference. That's the biggest difference between the 506C and the 506B. The 506C deal, you can only bring on accredited investors because you are allowed to go in on Instagram and make posts about it. On LinkedIn, you can post about your offering and all that, but you're only allowed to bring on accredited investors because they're considered in the eyes of the SEC to be more self-sufficient when it comes to making investment decisions.
Yep, absolutely. Is there a reason why you guys stick to 506B? Just preference? Is that most of your
Yeah,
audience?
yeah, I'd say a lot of people in my audience are non-accredited right now, And the funny thing is, a lot of people that I've been speaking with lately, they're at the point where within the next 12 to 14 months, they're going to become accredited. But right now they're not. And I love giving people like that an opportunity to invest in assets and opportunities that we have, because what other options do they have? I mean, a lot of these people, like for you and me, Satch, we're in this industry. We have peers that are doing all types of things in real estate and have amazing benefits. But if you're not in this circle, in this sphere, in this industry, it's like a non-existent thing. So giving these people the opportunity to do that, it's something that is within my purpose and it gives me fulfillment. So that is why I'm doing the 506B, but I do see the benefit of doing a 506C in the future.
Mhm.
Another reason that we've mainly done 506B deals is because that's what my team, who has more experience than I have, they've done that in the past. So it just kind of is in alignment with what they were doing. And at the time, I'm not necessarily looking to shift things just because I'm the new guy on the block trying to change up their plans. But in the future, I can see the benefit of doing a 506C deal for sure.
Yeah, yeah, for sure. So everyone heard 506B. You need to have a pre-existing relationship with this indicator. So if you guys want to be uh, shown, notified any investment opportunities that Jeffrey Dunnis may have, you got to connect with them, build a relationship with them, schedule a
Hmm.
call. At the end of the show, we're going to put a website where you can get in contact with them.
Yep.
Obviously, otherwise, he cannot be sending you any deals, right?
Right.
Um, I think, in my opinion, is Wall Street putting a constraint there, to not allow us. They want to, think about it, right? How many people they get their money from that they're not allowing to.
Right.
That money can go anywhere else but Wall Street, because that's the only place that they allow people to get their,
Yeah.
a portion of their paychecks. Every single paycheck they get a portion that goes to Wall Street, right? And it doesn't go to anywhere else. So that's just my
Yeah.
theory.
No, no, I
uh,
think it's true. Yeah. Some shady
yeah,
things going on.
yeah. Awesome, man. Dude, I like this. We're coming up with the end of our time over
Yeah.
here. What would you recommend someone that is just getting started in real estate syndications passively?
Yeah, so I would say the first thing is to start educating yourself by listening to podcasts like this one. Check out, Satch. I know you have a lot of content and things like that. Check out Satch's information on online. Look at us. Look at my brothers and I and the content we're putting out there, and other sponsorship teams. They're just putting so much content. Always be educating yourself. Perhaps starting to go out and surround yourself with other passive investors. I know there's really big conferences where a lot of passives and also active investors will go. Just start hanging out with people like that, start speaking the language, and eventually you'll have that knowledge where you can make an educated decision on who you're going to invest with. Because the main thing is just to understand who you're investing with, and then if their goals are in alignment with what yours are, and eventually you'll build your own investment philosophy, and that's how you're going to be able to make the right decisions so that your investments go well.
Cool. Absolutely. Like it. What's your favorite real estate book?
Ooh, yeah, yeah. So I don't know if this is a real estate book, but I love Rich Dad Poor Dad. But I'll say that first, and then the second one, that's like what got me into all of this. So I have to mention it. But ABC's of Real Estate Investing by Ken McElroy. That's a really
Mhm.
good book. That was one of the first ones that I read about, and it was specifically talks about property management in the multifamily space. So if you're interested in multifamily and how that works, Ken McElroy himself is an author, and he's a part of the Rich Dad Company, and he used to be a property manager, and now he owns his own property management company. So definitely knows what he's talking about, and I highly recommend that one.
Cool. Yeah, I've read the book. I like it. When I bought it, I didn't know it was going to be about multifamily.
Yeah, me
I just
neither.
thought it was just real estate, and I started reading it, and I was like, "Wow, this is pretty cool."
Yeah, yeah.
So awesome. Hey, Jeffrey, we appreciate you having you on the show today. Where can people find out more about you, get to know you, schedule a call, and know more about your investment offerings?
Yeah, if you want to schedule a call, feel free to visit our website. And if you want to learn more about us as well, visit www.donisinvestmentgroup.com. And if you want to get access to our free checklist, it's just that passive investors can use before investing with any operator or in any deal. Feel free to visit that link, www.donisinvestmentgroup.com/checklist. And if you want to check us out on social media, mine is at Jeffrey Donis on all platforms. And then my brother's account, if you will, our company account is at Donis. You spell that Donis Brothers on LinkedIn, TikTok, Instagram, YouTube, etc. And then check out our podcast as well, The Real Estate Monopoly.
Love it, man. The Dunnis brothers making good, big moves in real estate.
Trying to.
Jeff, Jeffrey, thank you, thank you for coming on the show today, man.
I appreciate you having me, Satch.